If you go to your daily chart, and we had our old all-time high here, okay, they formed as relative equal highs, this high being slightly lower than that one. So that classifies this as a high probability candidate for a run on liquidity. It's less likely when the right side is higher than the left because we've already done the damage there by running the wick of this candlestick. So we created this short-term all-time high and we traded lower. And then we had this candlestick here. We pierced it, but look, we only pierced it with a wick. That's not meaningful to me. It's insignificant. It's unfinished business, still above this candlestick high. So on this day here, we have October 2nd. The market creates this open. We trade down and we rally up here and then come off the high right there. This day, October 2nd's regular trading hours, opening range gap, that's what this 5-minute chart has been showcasing. Okay. So these levels here are what I was referring to. They need to be carried into the future. Why did I say that? Why not any other being specifically mentioned? I said in the October 1st that you should look back over the last 3 days. Always, if you have opening range level quadrants on your chart, go back over the last 3 days and include them. So technically, you're going to have whatever the trading day that you're trading, that opening range gap, if there is one in its quadrants, and then 1, 2, 3 days ago. So what do you have in your charts technically? 4 opening range gaps and their respective quadrants. So when I say you have to have 3 on there, it's not just 3 sets of opening range quadrants. It's today's trading day and whatever opening range gap quadrants there may be associated with it. And then yesterday, the day before it, and the day before it. And you have to go back into the previous week. If you're looking at, like, say, for instance, on Monday, you'll go back to Friday, Thursday, and Wednesday of the previous week. If there's a holiday, you're going to skip over that and just go to the market day that price was permitted to trade in. This day, we have a body left above the previous all-time highs. This right here is much more meaningful. So this day's opening range gap is going to be highly, highly significant. That's why I told you to carry it and go forward, projecting it forward. And you'll look at all these days here and you'll see those levels, which are these levels here, they're being used. So the candlestick that left a body above all-time highs, this logic also works when it's not trading all-time highs. But I've learned 20 years into my career that this is something that tends to repeat at all-time highs. Now, I've only had a few instances in certain markets to see all-time highs form. I've only been around for 53 years. But in my 53 years, the idea of a body being left above that old all-time high, this could be still used if it's just a old market high. If you're looking for the market trade above an old all-time high, it's this logic and any old high where we look at this candlestick, it leaves a body above it. Whereas by contrast, this one only wicks above it by a little bit. So I want you to understand there's a significant departure from just simply going above it price-wise and then leaving the body above it. Okay, this is much more salient and more information being indicating that the algorithm will now utilize that candlestick's opening range gap levels, and that's these levels here. Okay, I also showed this lower quadrant here. You'll see this in the chart slides as I go forward. It's perfect precision here. Why am I picking this one? Because it's the highest one in this swing high. Lower quadrant. Trades it, hits it perfectly, and sells off on that day of October 2nd, 2025. But now watch what happens. I want you to pay attention to the daily chart. Over here, we have a buy side imbalance, sell side inefficiency. Volume imbalance toward the discount end of that BISI, and its candlestick's low is the high. Graded, here's the upper quadrant, consequent encroachment, lower quadrant, and then the low. This portion here of that blue box is being shown right down here. The buy side liquidity pool here is this blue line right there, so that we can track everything. Thursday, regular trading hours, opening range gap, lower quadrant. This is the opening range gap low on that Thursday. That's this black line here. Consequent encroachment of Tuesday, October 2nd, opening range gap. Here's the upper quadrant, and here's the high of Thursday's opening range gap high. That's what's being shown here, okay? Over here, this candlestick here on the 2nd of October has a little arrow above it. That closing price, okay? Everything I'm saying here, when you're looking at markets trading at lows, that you anticipate trading below an old low and looking for accumulation to go higher, you're going to reverse everything I'm saying here. But for now, I'm focusing on how we can not predict. I'm not trying to promise you're going to be able to call the high in the marketplace. I didn't get it to high, but I'm showcasing how you can see real accumulation and real distribution in the marketplace. Okay. Bodies left above old highs right there. That closing price, as soon as that day closes and a new one opens here, that price right there and anything above it, smart money will start staging shorts. If we're making an all time high, or if we're making a long term high or a significant intermediate term high, and we expect to see a decline that's tradable, you want to reference in the market when it's bullish. If you're anticipating a turnaround, you want to indicate every up close price, the closing price. That's what I'm indicating here. So October 2nd, 2025, this price is what's being indicated, which now appears here on this chart. So everything at that price and above, smart money is looking for PD arrays to get short on. They're running out old highs, selling into that. They're selling into that. They're building large portions because they have to act like a commercial trader does in commodities. They enter early. When big positions are sought after, they start putting in positions early. Where do they and how do they do that? Everything above this closing price, anything above that price is going to be chased by what? Retail. But when they're buying it, smart money is selling to them as they buy. So at this point here and above to this candlestick here, all this is where smart money is accumulating swing trading perspective, that kind of like a duration of time, not a day trade, in other words. They're staging in that range shorts. And then we get this day, we have a higher close price than the previous one. See that? So now above that price and higher up to here, smart money is looking for PD arrays, old highs to sell into when it goes above it, or trading back up into premium arrays. They're selling short inside that area. And then finally, we have this closing price here. So we have 1, 2, 3 stages of smart money shorting. They're staging their short positions. As the market's going higher, they're feeding that buy liquidity to the people that want to chase price higher. They keep, oh, it's going to keep going higher. You can see what they're doing with the candlestick wicks. See that? Yeah, we were here at this highest point here, but we closed down here. Yeah, we were high up here, but we closed right here. We were high up here, but we closed way down here. We we are high here, but we closed right there. That's distribution of longs and accumulation of shorts by smart money. Do not think like this only with all-time highs. Every time the market creates intermediate term or long-term highs, it does these same things. It does these same things. But all-time highs, you want to see an all-time high form and then a deep retracement and then it gets taken out. And then start looking for these types of scenarios. Okay. So here we have this portion here at this candlestick's closing price and anything above it, they're going to be utilizing premium arrays and selling short of old highs because they have deep pockets, because they are essentially agents of the market where they're literally privy to certain things. They don't have to have the same concerns that you have to have. You want to trade big positions, very, very small stop losses. They don't need to worry about that type of stuff because they're not over leveraging. They're scaling in, they're scaling in, they're scaling in. Now, time element. It's Friday. We're at all time highs on Thursday. We open up on Friday. We trade up into that Thursday high and we grade that. Okay. Upper quadrant's pierced, but we can't get to the high of it and we trade lower. So we jump ahead and we're looking at Tuesday price action. We open up higher. We have a small gap in here. So it's regular trading hours being shown. And the idea is that we see it trade lower above this closing price. So we use that price here. So there's discount sensitivity. It rallies above previous high here. So what's above that? Buy side. So they're selling into that. They're selling into that. We come back down into that October 6th closing price. Then we have a gap opening higher. We rally above previous high. Then we sell off. Small little civvy in here, sells off and trades down into what? Thursday's regular trading hours opening range gap low. That's this dark line right here. You'll see it annotated in a moment. Here's the lower quadrant. Here's consequent encroachment. Here's the upper quadrant. Here's the high of it, which is the opening price on Thursday, October 2nd. So don't be confused with these annotations. I'm referring to only October 2nd. Why? Because it was the candlestick that had the body that was left above the previous all-time high when it formed and then retraced away from it. Really, really important. You're going to need to watch and listen to this video a few times, but then go back and look at your old price moves. It doesn't need to be all-time highs, and you'll see exactly what I'm saying is the truth. Moving forward, here we have Wednesday, October 8th. Now we're above that October 6th closing price. That's over here. All these wicks, we're seeing that form in here. So everything in this price run up here, again, every time price runs above this high, there, smart money's staging. They're adding to their short position. This high here, as it trades above it, they're adding to their short position. Here, this high, as it trades above it, they're shorting more. Up here, they're shorting. What is this? It's an inversion fair value gap. Price breaks that low, trades down. There's your short inside of another fair value gap there. Trades back down. What's it trade down to? Tuesday, October 2nd, 2025, regular trading hours opening price. That's the high of that opening range gap on October 2nd. Hits it, and what does it do? Stop. It flirts just below it a little bit with the wicks and then rallies away. Why is it using that level? And now here we are, D-Day. Here it is. The market on the 9th. Here's Thursday, creating the high. Okay. We have the market trading in an area where the October closing price here on the 8th. The 9th, we open, we rally up in this little portion of price action in here. All this, that's being graded up here. You can see those levels here at 25,393 even. That's this candlestick's high. Okay, so it's over here, previous. Looking at it, the bodies are stopping right at consequent encroachment right here. And we're above buy side on this swing high here. Deep retracement. It trades down into what I tell you? Thursday's regular trading hours opening price. So that was the high of the opening range gap on Thursday, October 2nd. The only reason why we're constantly keeping these levels on our chart is because on the daily chart, it was October 2nd that left the higher bodied closing price above the previous swing high that made all-time highs. Carry that over into when you're not trading at all-time highs, just using it for market structure purposes. When you're trading above an old high and you're expecting a long-term or intermediate-term high to form, you're using the same logic. It just works more frequently because it's rare that your markets that you're trading are at all-time highs. It takes a lot of time to get to these all-time highs in markets. So here we have it. So point is, the market's already indicating it's tipping its hand. The bodies are not able to close above consequent encroachment of the 9th price action. So when we start trading on the 10th here, it's faltering, it's failing. It can't muster up the strength to get into a run to make a higher all-time high. And we've had 3 stages of smart money shorting. This price that is too far to the left is the old buy side. It trades above it here. That's your first indication that we laid down a body and a closing price at a all-time high, above an old all-time high that was a swing high. So here's the stage 1, here's stage 2, and stage 3. Anything above those closing prices, smart money is putting in shorts. They're selling. They're selling to the public. They're selling to money chasers. The market trades right back above, right in here, above buy side here, and taps October 8th, 2025's closing price after just a hair pierce above it. And then that happens. Inversion fair value gap, small little volume imbalance in here. You'll check your price to see it. It's very small, but it's there. Market trades up, falls out of bed. 3 stages of smart money selling above an all-time high, indicated by failure by the bodies not making any headway above consequent encroachment. If it would have been above it, then we might have to make a higher high, but it's not. When you start seeing the science that I'm showing you here and the closing prices are giving telltale signs to smart money that it's about to turn. Why? Because we couldn't post a body above consequent encroachment of this wick. And it's time Friday. Inversion fair value gap, failure to go higher. We're consolidating. And then we go into the macro, 10:50, 11:10 a.m., overlapping with London close. And then the market starts to drop. So here's where we're at. Inversion fair value gap, macro 10:50, 11:10, trading at the closing prices, third stage of smart money shorting at all-time high. And one more tap into that buy side, and it careens lower and back into that those Thursday levels. We trade down below consequent encroachment of Thursday, October 2nd, 2025's opening range gap. It wicks through it twice. Where's the bodies below it? Why am I using that Thursday, October 2nd opening range gap? Because it's the one that had the daily candlestick close that laid down a new all-time high above a previous all-time high that was formed, that was retraced on. So it should be viewed as what? Continuation. But I'm looking for indications that smart money will fade into that and start selling it. Volume and balance, volume and balance. This is what? Suspension block. Halfway point, consequent encroachment. Can't even reach that. And the bodies are staying below what? Thursday's regular trading hours, opening range gap, consequent encroachment, midpoint level. It can't even muster the strength to come back and kiss it with its bodies. It's weak. It's heavy. So where could it reach for? Go back to your daily chart. We have a swing low. We have a discount wick that you can grade. And then we have the change in the state of delivery down here. See this down close candle all the way past this one. So if we're going to pierce this, this is the last time after or before this candlestick formed. This was the last time there's a change in state of delivery. So this candlestick's open to its high. That is your premium wick. When price is above it, it's going to act as what? A discount wick. So here's the lower quadrant, consequent encroachment, and the upper quadrant. Lower quadrant comes in at 24,166.50. And during regular trading hours, trailing stop losses getting stopped out. It is what it is. But that is a really, really nice run. Carrying it over to electronic trading hours, where you can see that there's trading beyond that 4:14 p.m. Eastern time. This big drop off went right down into that there beautifully. Wick just below the low, but look at that delivery. It's completely random, I'm sure, in most of your eyes.